Are you curious about the housing market in the East Tennessee area? Let's talk about current conditions and what we can expect or what's predicted for 2023. Okay, so everything we're going to talk about, I am using data from the Knox Area Association of Realtors, CAR. So the slides you're going to see, the information, the graphics are all from CAR. Hanson Sell is the Government Affairs and Policy Director at the Knox Area Association of Realtors. So just want to give full credit to the research and, all these things. So this is kind of me going over what CAR is predicting, where we are currently in the East Tennessee market, and then what we can think about or expect or what's being predicted, however you want to say it, for the 2023 year coming up. So first of all, let's talk about what's happened in 2022. Now this data is of about, this does not include December 2022 data just because we don't have it yet at the time of the making of this video. So just an overview of the general market, Knox area market. We're seeing that the economy and the housing market have both cooled. We're seeing that obviously things are not as crazy as they were the past 2 years. We are definitely out of that pandemic era market in the sense that we're not seeing, super quick turnaround in terms of a home is listed and all of a sudden you've got 20 offers. We're not seeing these skyrocketing prices. We're seeing houses, staying on the market a little bit longer. So definitely that pandemic era housing market is officially over. That being said, for 2022 overall, again, not including December, we saw that the median sale price was up 14% year over year. We're seeing that home sales themselves dropped 10%. Active listings went up 50%. So we saw that, last year we had, 1,500 houses on the market and now we're actually around 3,600. So again, this does not include December data, but I'm just telling you, we've seen a huge increase in active listings. And then as far as the mortgage rate, obviously it is up 6.33% year over year. So that's just a kind of look at what happened in 2022. And then just kind of situationally what we're looking at. So CAR does do a survey of agents. I myself completed the survey, and agents reported that, over the last quarter of 2022, what we've seen is that buyer traffic has slowed, and I can definitely say that, although I will say towards the end of December, we're seeing a slight pickup. And we're also seeing that seller traffic has decreased. So while buyers, not feeling so great, sellers also not feeling so great because a lot of people don't know what to do when it comes to the actual interest rate. So when people are uncertain, we're seeing that people aren't taking action, which obviously if you're confused, you don't know what to do, you're probably not going to take action. You just kind of hold on. We're even seeing builders in the area that have done that, where they've kind of stopped building at the moment, towards the end of this quarter because, who the hell knows what's going on, okay? So the other things that agents within the CAR association said is that they're having fewer issues with appraisals, shrinking of appraisal gaps. So appraisals not so much an issue. And we're also not seeing buyers that are just like, yes, I will make this huge $50,000 difference between what I offered and what it appraised. We're seeing that is not happening as much. We are seeing, agents that completed the CAR survey for this last quarter said that they're seeing more local buyers. I myself am not seeing that, but I'm also, positioned to be working with people that are moving here to Tennessee. So I don't necessarily see that. I see a mix of both people migrating here as well as people within Knoxville. So I don't necessarily agree with that, but overall agents who completed this study said that, or the survey, said that they're seeing more local buyers. They're seeing a decline in investor activity. I don't agree with that one either, but again, I have a little bit of a different clientele. I do have clients specifically that is what they do. They are investors. Also, agents reported that homes sold in quarter three received an average of 2.5 offers, Whereas quarter one of this year, on average, agents reported that houses were receiving 6 offers. And that I can definitely, from my own personal experience, I know I'm a sample size of 1. I definitely have seen that trend where we're not seeing, crazy offers right out the gate. So I definitely think that there's definitely a decrease in the amount of offers and competition that listings are seeing. Agents also reported that there's more contract delays due to terminations, due to home inspection. So actually I saw more terminations due to home inspections in the second quarter. I haven't seen that so much in the third and fourth quarter of this year, but overall agents did say that. And of course, overall, the agents that responded to the survey said that there's less competition, which I 1 billion %, if that were even a percentage, I 1 billion % agree with that. It's funny because I'm used to be a math teacher, which you may or may not know, and I would say like crazy things like that. And some people would be with me and they would think it was funny, and other people just stared at me. So I don't know which one you are, but hopefully it's somewhat entertaining and not just a bunch of dry stats. Okay, so that being said, what does the data say? So we've heard what agents have said. Now let's look at some of the data. So overall, we are seeing that inventory has tapered off. We are seeing that if we compare, so what we started to see was that with rates going up, we also kind of started to see that inventory was increasing, but we have not seen that same trajectory of increased inventory that we started to see towards, August, September, October. We've seen since October like a decline or a taper off. So we are still not to pre-pandemic levels of inventory. We are not even near anything that was like the 2016, 2017 market in the Knoxville area. And even at that time, that was considered to be a very strong housing market. So from this graph, you're seeing that, new listings, we're just kind of seeing really a tapering off, and active listings have just declined since 2016. We did see an increasing amount coming back up towards, like I said, August, September, October, and now what we're seeing is a tapering off where that active new listings are not increasing as much. We're also seeing that homes are staying on the market longer. If you look from July of 2021 until December of 2022, we're seeing, over 20 days, median days on market, which is insanity because in 2021, nothing's an exaggeration, but we were seeing our median days on market like 4. July of last year, so July of 2020. So definitely an increase of the amount of days that houses are on market, and that kind of goes in line with that idea of also we're seeing less offers, right? Because if you're getting more offers, they're probably made very quickly, the bidding war, as people will say, etc. We're also seeing that prices are high, and we're also seeing that prices are not decreasing. So from 2016 till 2022, we're seeing a steady and clear increase, although 2021, we did see a bit of a more sharp increase in prices, where now our median list price is in the 400,000s. Even beginning of this year, that was mid 300,000. So definitely a change in prices, and we are not seeing any prices decreasing. So the projection is, which we'll get to this, is that prices are not going to be on that same positive or as high of a slope as they were. That slope is going to flatten a little bit, but prices are not projected to go down. So that's prices. We know that they're high. We know that they're rising. And it's also interesting, what we've seen from 2015 until now is that the luxury home sales have elevated. So that would be any home that's worth at least $1 million. So what we've seen in both the Knoxville area and Knox County, we've seen increases in $1 million homes steadily. And then specifically from 2020, get a load of this, from 2020 in the Knoxville area, there were 192 homes that sold that were over $1 million, okay? In 2021, that number was 507. And then in 2022, that number is 647. Yo, that is insane. Crazy growth in the luxury home sales market. So take that as you will. It's kind of interesting. Not something that I necessarily would have predicted, but it's interesting. So other things just to note when we look at investor trends. So this is what the data says. It says that investor home purchases are down 30% year to date. In quarter 3 of 2022, we saw a 57% decrease in iBuyers. So those are institutional buyers. Those are people who have a specific buy box for a house that they're looking for. And when I say a buy box, it's like basically they want a 2,000 square foot house with 3 bedrooms, 2 bath, that's not near a railroad or whatever. They have specific things that they want. And so we've seen a 57% decline in institutional buyers. And those are big kind of, I think of them as like industry, which doesn't make sense because it's not industry, but I think of them as like big investors, like corporation, basically. There was also a 27% decline by investors who own 100 or more homes. So investors that are heavy hitters, they own 100 or more houses. We saw a decline there. And then we also saw a 22% decline in small investors. So definitely a decline in investors making moves within our market. So it's also interesting to note that over the past 2 years, Carr mentions that it could feel like a housing crash right now to anyone who has entered and exited the market recently within the past 2 years, but it's really not obviously a housing crash. It's just that we're shifting more to a more normal market, even though for the Knoxville area, we're still low in inventory. It's not necessarily normal if you look at like 2016, 2017. And then we also saw in this last quarter of 2022 that there is a rise of the of a rate buy down, which we obviously didn't see when interest rates were in the 2s and 3s. So those are just some other trends that the data is pointing to. So when we look towards 2023, some challenges that Carr mentions to us are number one, consumer pessimism. So people just don't feel great about right now being a great time to buy. And so this is from a survey, the Fannie Mae Home Purchase Sentiment Index, HPSI, Home Purchase Sentiment Index, from Fannie Mae. And essentially the overall result is that 16%, or that 4 out of 5 Americans says that it is a bad time to buy. So that's 20%, nearly 20% of people that responded said that this is a bad time to buy. You should not be buying right now. Whereas if you look at 2010, 70% said it was a good time to buy. So we have only about 20% of people responding that said it was a good time to buy. 4 out of 5, I messed that up. 4 out of 5, 80% saying it's a bad time to buy, aka only 20% saying right now is a good time to buy. And actually the stat is 16%. So roughly 4 out of 5, a little bit less than that, saying that right now is a good time to buy as of October 2022. As far as consumer pessimism goes, there's also pessimism when it comes to the mortgage rate itself. So 52% of people that were surveyed, this is from the New Home Trends Institute, said that they thought a 5% or lower interest rate is normal. And that's actually not the case. So with 52% of consumers thinking that the interest rate is normal under 5% and we're sitting at a 7%, like obviously that's going to cause pessimism because people think that interest rate is too high when actually 5% is not the historical amount. It's more close to the sixes. So anyhow, that's another thing when it comes to consumer pessimism. People aren't feeling great about this interest rate because over 50% of the population is thinking that what's normal is 5% or below, and that is not correct. So a second challenge is when it comes to inflation and mortgage rates. Obviously inflation we are seeing, this is a problem. This is a chart from Freddie Mac and the US Bureau of Labor Statistics showing that real mortgage rates when adjusted for inflation have actually turned negative. So in other words, the cost of borrowing money is below zero. And so when it comes to a 30-year fixed mortgage rate, basically that mortgage is better than if you were just trying to hold on to that money. In other words, if that makes sense. So that mortgage is essentially more secure than what's happening with inflation, which I think maybe goes without saying. But anyhow, also we have noted that what has been a challenge is that when it comes to inflation and the Fed's rate, this is the most aggressive action we've seen from the Fed in 40 years, with a major increase even just since March. And so this obviously impacts lending and spending. And we've also seen that many lenders are factoring in these expected rate hikes. But again, we do anticipate that mortgage rates will continue to be elevated as a result of what's happening with the Fed. So that's regarding inflation and mortgage rates. A third challenge that we're seeing is housing affordability. So because we're seeing that rates have increased, we're seeing that obviously what you need for a down payment has increased, your monthly payment is more, your costs in general to get into a house and then also maintain the house have increased because you've got a higher down payment and then a higher mortgage rate. So if we look at, the change from 2021 to 2022, we've seen that we went almost 4 points higher when it came to an interest rate. So we also saw that the median sale price increased by $30,000, which meant that overall that down payment and closing costs increased about $2,400 on average. And the monthly owner costs increased by nearly $1,000 at $855. And here's the thing, here's the big kicker. So in order for people to get into a house, the annual income that was needed in 2021 is said to have been right at $59,000. And then the Knox Area Association of Realtors is saying, based on this shift and these changes in the rate, the amount of house and cost for the house, that in October 2021, in order to afford the median sale price of $315,000, you would need an annual income of $93,000. And so to put this in perspective, essentially you would need a $30,000 raise within a year in order to afford the median priced home. And so that's not very realistic. That's a change of actually $34,000. And so affordability is kind of one of our very big challenges when it comes to the Knoxville area. And it's interesting because I talk with a lot of buyers who have been looking at the Knoxville area for several years to relocate here. And what they found is, since they were looking in maybe 2018, 2019 until now, prices have majorly increased. And we can definitely say that over the past year, prices have certainly increased. So affordability is certainly a concern when it comes to the Knoxville area and the Knoxville market. It's not necessarily cheap. We are seeing again, that you would have need a $34,000 pay raise, which whoever got that, whatever job you got, that's significant because that's not normal when it comes to a pay increase. And then this is essentially what we're seeing is that the majority of residents within the Knoxville area can only afford, essentially 2/3 of the population can afford less than 1/3 of the active listings. So again, essentially 2/3 of the population can afford less than 1/3 of what's actually listed for sale. So that is again another problem when it comes to affordability in the Knoxville area. Also, when it comes to affordability, we're seeing that for younger home buyers, there has been a significant shift in the amount of action that we've seen. So for 2019 and 2020, we saw that there was, an increase in that 25 to 34 age buyer. But we actually saw this year that we had, or in 2021, a 5% drop in that age range. So additionally, when we look at who's buying houses, we can see that we did see a dip in nearly every age gap, every age group, 25 to 34, 35 to 44, etc. And this is the CARS analysis of home buyer data. And what we're finding is that essentially, while all age groups saw a decrease from like 2020 to 2021, those hardest hit were young home buyers. That's the 25 to 34 age range, as well as the 55 and up. Those kind of age groups were most impacted when it comes to what happened with the pandemic. And we saw that they there were less mortgage applications of those age groups. So anyhow, another challenge as we look towards the 2023 housing market is the overall housing shortage. Now, this is specific to East Tennessee specifically, and a lot of what we're talking about today is data specifically from the Knox Area Association of Realtors. So we're talking East Tennessee, and we're talking about the counties specific to the Knox Area Association of Realtors. So it is interesting to note that a lot of the country and a lot of what you're hearing is that inventory is way up, blah, 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 but that is not actually the case for the Knoxville area, and the expectation is that inventory is going to lag behind considerably. And if we even compare how Knox County looks when it comes to other major counties within the state of Tennessee, we see that, for example, in Nashville in 2021, Nashville produced new housing at 4 times the rate of Knoxville per capita. So it's not just because it was bigger, it's per capita. Per 10,000 people, Davidson County, the Nashville area, produced 4 times the amount of what Knox County produced when it comes to new housing and new building permits. You can also see from this graph, Knox County is in orange, and we are only just ahead of Shelby County when it comes to new home permits. But from 1990 until today, we have never been at the top of that new building permits. And so that's one of the reasons why we're seeing that inventory remains to be low, is because we are not producing, we're just not building at the rate that needs to be built at. Now, some other metrics when it comes to, new construction, new building permits, obviously we saw price volatility when it came to, even this, I know we all talk about lumber, obviously major price volatility. We talk about windows, garage doors, all these things where if maybe lumber kind of leveled back out, then we saw that there was a problem with metal or whatever. So we're also seeing that finished lot prices have increased by 15%. New home prices have increased by 11%. We're just seeing that prices are up, and then we're also finding that home starts are down as a result of these increased prices. So, that, and again, has not helped this inventory problem that we've seen. So it's not only that sellers aren't listing, it's also that builders aren't buying. And specifically in the Knoxville area, we've been behind other Tennessee counties since the 1990s, if not longer, based on the data that CAR has shown us. So another challenge that we're finding when it comes to looking into the 2023 real estate market is the lock-in effect. So this is people that are able to lock in a rate, right? And so something that is really great is someone that purchased a home in 2021 or that refinanced in 2021, they might have an interest rate in the 3s or high 2%, right? So if you are now thinking, okay, well, I need to move or I want to buy, but you're locked into a rate that's low and really great, then you're probably not going to be thinking, let me go buy a house with a 7% mortgage rate. And so as a result, we're seeing almost like a freezing of people not taking action because, people don't want to trade up because the rate itself. And so that means that, people aren't wanting to move and instead may be remodeling. They may be staying there. They may be improving their current house. And an interesting stat is that 73% of outstanding mortgages, 73% of people that have a mortgage, they are locked at a rate below, or locked in at, when we say locked in, it sounds horrible, but in this case, it's a good thing. 73% of outstanding mortgages are locked in at rates below 4%. And so therefore, if you're thinking, okay, well, I'm going to buy a bigger house, but my rate's going to go to 7%. It's like, well, what are you actually going to get with that, and is it worth it, right? It's kind of interesting to think about that. Almost 3/4 of those with mortgages are locked in under 4%. So why would you be, for a lot of people, it's like, well, why would I sell or buy right now because of that rate? So like I said, we've seen that buyers and sellers have both pulled back because if you're locked into that rate, and then we've seen also an entry problem when it comes to first-time home buyers or buyers at a lower price point, just not being able to even get into the game to afford to buy a house to begin with. And then something else that we've seen as a result of this lock-in effect, really since, October, September, August of this year, is that both new listings and pending listings have gone down. Sellers, buyers, everyone's like, we gotta freeze. And so that again goes and speaks to this idea of uncertainty and people being unsure of really which direction to take. So that being said, I do want to note that even though we are seeing, a different market than we have seen the past 2 years, this is not the start of the Great Recession. And there's several reasons why we can look into that. And one of the key things that I want to point out to you is that when it came to the 2008 recession, people were basically doing stated income, I'm going to state my income and you're going to approve me based on that. It's not like today where ask anyone who's recently tried to get a mortgage, they need to see documentation, and you've got to show that proof of income. You've got to show, you have to put your money where your mouth is, in the sense of you got to show proof that is what you make, and where does your money come from? Basically all the things you need. You got to answer millions of questions, and that was not the case in 2008. And so that being said, there's much more tighter or higher standards when it comes to who can be approved and who is not going to be approved for a mortgage in general. And then also note that there's quite a bit more equity when it comes to people in houses today. We're seeing a higher percentage of people that have equity in their home versus people underwater that have overpaid. And some of you may be thinking like, what? Well, people were just paying crazy prices. However, those people paying those crazy prices were qualified to do so. And so it's not like the bank was just lending to anyone in this situation. They were lending to those that were qualified. And then also, if you had the cash money to pay over the appraised value, you had the cash money, right? Also note that in 2008, there was a high mortgage delinquency rate, and we do not have that in 2022. So there is a lot of differences between the 2022 market and the 2008 market. They are not the same. And so this idea of like a bursting bubble or everything's gonna go to disaster is unlikely. And then the other thing to think about is homeowner equity. And homeowner equity is actually at an all-time high, which means that homeowners are not out leveraged, that they have the money, they have equity in their homes. They're not in a situation where their house is worth $200,000, but they owe $300,000 on it, right? Like that is not the situation. So that is a positive thing. And again, mortgage delinquencies are at a record low. So that's a really, really great thing. Even though I know sometimes it's like, oh my gosh, what's happening with the rates? But actually people that are owning homes, the majority of them are actually in a really good position. So that is something that is, I think, super positive. So when we talk about, is the bubble bursting, then what if home prices were decreasing, which they're not, especially not in the Knoxville area. But Redfin did a study and has run the numbers, and the data says that even if there was a major change in home prices from November of 2022 to December of 2023, even if home prices stayed flat and didn't increase, that only 1.6% of homeowners would be underwater on their mortgage. Again, if home prices didn't do anything, that only 1.6% of homeowners would be underwater. And so that would be, that's a very small percentage, right? They said that actually the study found that between November 2022 and December 2023, if prices went down 4%, that the percentage of homeowners that would be underwater would be 3.4%. So again, low. What if home prices dropped 8% between now and December 2023? 6.3% would be underwater. And then say something crazy happened and home prices dropped by 12%, then just 6.3% of homeowners would be underwater. So that being said, even at that 12%, that's the first time that we see negative home value. We see that even if prices stayed flat over the 2022 to December 2023 time frame, if prices stayed flat, It's the change in the typical homeowner's value of their home is $44,000. We only hit the negative if we're seeing a 12% price decrease. So that is historically, I don't want to say impossible because everything is possible, but it is highly unlikely. Again, that just indicates we are not in a bubble. And so it's interesting to also think about demographics when it comes to this idea of a bubble bursting. And we're seeing that we have an increase in the sole person household. So one person within a household, this has nearly doubled over the past 40 years. And we expect this to continue to grow. So in other words, more people buying houses because more people are living on their own. And we're also seeing that prime home buying age, 20 to 34, has increased as well. But overall, what we're finding is that 39% of baby boomers represent a sole person household. So because of this, we have shifting priorities and we have more people actually buying. It's not that people are staying within a unit as we've seen in the past. And so this has been a change from 2010 to 2020. So that's drastically different than what we saw in 2008. Additionally, we've seen that this kind of goes with what I was just saying about who's buying, this idea of sole person households. The household size has been declining since 1960. So if we look at 2005 until today, we see a drastic difference in the share of households that are, somewhere between 3 people, and now we're at 2.5, which obviously not half a person, but you know what I'm saying. That would always be like such a math teacher question, like, how many people will there be? Well, and the answer would be like 2.67. And so the answer was like 3 people or whatever. That's such a math teacher thing. Anyhow, that being said, what we're seeing is that household sizes are declining, which is a drastic difference from just over time since the 60s, but even since 2008, this is a definite shift. And again, encourages us that we're not going back to that Great Recession when it comes to the housing, especially in the Knoxville area that we saw in 2008. Also, we have seen a major influx of people moving to the Knoxville area, and this is Redfin data. But even if you just look by quarters, we're seeing as of April 2022, 2,200 people coming in, whereas like in, let's see, January of 2020, we were just around 100 people. So we have seen a major influx of people that have come into Tennessee. And although realtor data from the last quarter of this year, according to CAR, is that we're seeing a decrease in that, I actually disagree, but that's just in my own personal clientele. So that being said, let's get into what's happening with 2023 and what we can forecast, what is being forecast for the upcoming year. So essentially what we're seeing is that we think that the overall fixed mortgage rate will be around 6.4, whereas 2022, the average was about 5.4%, and 2021 was 3%. The prediction is that home prices will increase 5%. For context, in 2021, that was 20%, 2022, 14%. So this idea is that prices are not going to increase. We're just going to see a slowing of that price increase around 5% overall. We do have the prediction that home sales will decrease by about 12%. But, whereas in 2022, we saw a decrease of 10%. And then overall, the dollar volume of closings would be down 8%. So 6.4% interest rate on average, prices up about 5% over the year, and then a decrease in home sales and overall sales volume. So those are major predictors. When we talk about the actual rental market itself, the rental market is said that it will cool. Although inflation data suggests that rents are increasing, the data that CAR presents and has found does not agree that rents have increased. And actually, if you look at quarter by quarter over the past year versus the last quarter of 2023, I know in my own, 2022, in my own research for some of my investor clients, definitely there has been a slight decrease in the amount of rent costs, I will say. Also in the Knoxville area, there is a record number of units said to be coming online for rent over the next 12 months. And so that means that there's going to be more supply, which should in turn result in less demand and a lower cost for rent. So in general, that being said, right now we are at a 98% occupancy rate. Ideally, for a healthy rental market, we want that around 94%. But the projection for 2023 is that occupancy rate for rentals will be about 96.6%. And just a slight change in rent amount from $1,300 a month to $1,355. So that's a change of about 4% over the year of increase in the cost per rent. And that's basically all rent. So that's everything from a studio to a 2-bedroom apartment to a single family home that's for rent. So when it comes to this idea of, okay, what are possible scenarios in the real estate market in the Knoxville area? So, from this chart that you can see, essentially, if there is no recession, there could be a 5 to 5.7% mortgage rate. We could see home prices increase about 5% or more, and then home sales decrease by 5%. That is a bullish, kind of aggressive market. If we look at the baseline, no recession, mild recession, again, that mortgage rate up to about 6.5%, slightly positive when it comes to home sale prices, and home sales down by 12%. And then if we were to go into a severe recession, that would mean rates above 6.6%, home prices decreasing, and home sales dropping 20%. And so those are 3 possible scenarios. I do not think that bearish scenario is very likely, just simply based on the inventory that we have. And again, the influx we still have coming in the Knoxville area. My personal opinion is that will not happen. So overall predictions, when we look at 2023, is that 2023 is not really a buyer's or seller's market, just strictly based on this idea of the locked-in effect that we talked about, where 73% of those with a mortgage are locked in at a rate at less than 4%. So there's going to have to be a major motivation for someone to sell or buy. And we also know that affordability is an issue. And so if you're a first-time home buyer, this is not really the ideal market for you because the cost of entry has increased. And unless on average you've gotten a $34,000 raise, then it's going to be a bit more tough for you. The other prediction for 2023 is that home sale prices will kind of hold steady, that we're not going to be seeing a drop. We're not going to see this major increase that we've seen the past couple years, but that prices will hold steady, at most a 5% increase overall. And again, I know I keep saying this, and I just want people to be grounded in this idea of the third prediction for 2023 is that housing inventory will increase, but it will continue to remain below pre-pandemic levels across most of East Tennessee. And again, this comes to this idea of new building permits. It comes to the idea of everything that's happening with the market, with both, we're already low, right? So if sellers aren't listing, then we're not seeing increased inventory from sellers. But if we're not having new building permits, we're not seeing new inventory of new construction. And so therefore, we're going to continue to see this low pre-pandemic inventory level continue. And then another prediction for 2023 is that affordability is going to be kind of a major predictor in what does actually happen in East Tennessee over the 2023 market. And when I say affordability, I mean specifically mortgage rates. So if we see mortgage rates start to come down, we're going to see affordability obviously is going to be higher, which means more people are going to be able to, or want to, number one, and also want to take action to buy or sell. And then another interesting prediction for those of you that are interested in what's happening in the commercial real estate market is that the East Tennessee's commercial real estate market will cool as well. And this will cool, but that there will continue to be strong interest for office spaces and multifamily. Multifamily to me is like this hot word right now. Everyone's talking about it. If you hear this in any real estate investor circle, everyone's talking about multifamily, and that will continue to be hot in 2023. So credit to the Knox Area Association of Realtors and Hanson Sell, who is our kind of economic advisor person. His official title, sorry, Hanson, I don't want to get this wrong, is Government Affairs and Policy Director. So shout out to Carr for the research. And obviously I would love to hear your thoughts, your considerations, and I will see you on the next video and we will see what happens in 2023.